profiting from property investing can be turned into a science if you know what data to use and how to use it. This is the final episode of our 4-part series where I walk you through the framework I created with InvestorKit founder Arjun Paliwal that's never been publicly shared before. This framework is an integral part of how we helped our clients make over 350 million in equity. And for the first time, I'm gonna share it with you. I'm Junge Ma, the lead research analyst at InvestorKit. In this 4-part series, we open up the 4 pillars of profit-driven data, what they are, why they are important, where to find the data, and how to interpret them. Plus a bonus at the end where I will be busting a data myth that could cost your portfolio growth. We've already covered population demographics, construction activity, and economic strength in the first 3 episodes. Click here if you missed them. But now it's time to unpack the importance of affordability in property investing. So now we're talking about the 4th pillar, which is affordability. When it comes to affordability, everyone has a different view on it. If you are a Sydney-sider, affordability for you could be right under 1 million. But if you live in Perth, affordability for you would be under 500,000. So that is the individual affordability when we're talking about it. But over that, if we want to measure the affordability of a city or a region, what we need to do is to measure the relative affordability. Basically, we compare the median house price with the local income level. And when we look at relative affordability, there are 2 usual measurements we would use. The first one is called price to income ratio. Many reports, including the ANZ CoreLogic Affordability Report, they basically calculate how many times the median price of the local house. And another measurement which is used by InvestorKit is actually compare the median house price with the affordable level of house prices of a certain region. The affordable level of house price is calculated based on the assumption that when you only use 30% of your total income to pay your mortgage, that is deemed as affordable. This threshold is commonly used by almost everyone when we measure housing affordability. And how do we calculate that? I'll introduce that to you in the how part. And then another affordability we want to measure is the rental affordability. Very similar as housing affordability, we also calculate rental affordability based on the assumption of 30%. If you're using 30% of your total income to pay your rents, or less than that, that's deemed as affordable. Otherwise, the rental affordability is bad. So now we have covered what basically we would be looking at individual affordability, housing affordability in terms of buying, and rental affordability. Now let's talk about the why. Why affordability is important for housing market. We can look at this in 3 ways. First, intuitively, if we think the great performance of Perth, Brisbane, or Adelaide, what's behind their strong growth? Besides the reasons in relation to their property market cycle, or the shortage in supply, or the huge amount of internal migrations flushing into these markets, affordability is actually one of the main factors that's boosting the housing price growth. And the second way we can look at it is more statistical. If we plot all the Australian regions based on their median price last year or affordability last year and their 1-year growth from this time last year to now, you find a very significant negative correlation between the affordability and 1-year growth. So basically, the more affordable the regions are, the better growth they have achieved over the last year. And this negative correlation has happened 2 years in a row, ever since the interest rates started to hike. The third angle we can look at it is within the same city, different prices of houses are actually growing differently. One example is Sydney. Based on the CoreLogic Home Value Index report just released in May, Sydney's most affordable houses actually grow better than the most unaffordable houses. So that is 3 angles you can use to look at the importance of affordability to the housing market growth. Now, let's move on to where we can find the data to determine affordability. As we are comparing the house price levels with the local income, we need to know 1, the income level, and 2, the price level. And we'll look at income level first. For income level, again, we use ABS. And then we'll move on to the price level. To access income information on ABS, I usually just starting with Google. First thing we can Google is personal income Australia. And the first result is actually what we need. It is, this is the latest release of an estimation of personal income. They have given some snapshots here as tables and charts. But if you are interested in the raw data sets more, let's go to data downloads. All these tables on different levels are available for you to download freely. And besides this, as you can tell, this is for financial year 2020 to 2021. It's a bit old, not too up-to-date. So what we can Google next is a more up-to-date one, which is weekly earnings. First one is the latest release. It is up to November 2023. It is more up-to-date than the previous, but the disadvantage of this one is that it's only available on a state level. Again, if you are interested in the raw data sheets, here are all the tables freely downloadable. So that was the income data we can download freely from ABS. Now I'm gonna show you some data sources for house prices. First thing we want to look at is the realestate.com suburb profile. They have all the property market information on a suburb level. And let's start with Google again. For the suburb profile, what we can do is to search REA suburb profile. The first link is the homepage of it. Let's try with the suburb, and I'll try with Bella Vista. Bella Vista, New South Wales. There you go. On this page of the suburb, you can see house price, house market data and rental market data, and unit market data. Well, in house market data, it's both on the sales side and the rental side. This includes 5-year price growth, the current price level, last 1 year growth, number of listings, number of interested buyers or renters, and days on market. And also they have this bedroom filter where you can filter out the number of bedrooms you are interested in. And if we move on to the unit market, they also have the sales market data and rental market data. And again, you can filter by number of bedrooms. The thing with the realestate.com suburb profile is that they are only available on a suburb level. What if you want to check on a higher level? Where you can go is SQM research. And I will show you here, starting with Google. We just search SQM research, which is the first suggestion, and the first result is it. They have information on property market, shares market, and managed funds. And what we need is the free property data in the property section. Here, what you can see is auction results, upcoming auctions, number of listings, vacancy rates, and more. And for price, what we want to check is asking property price. On this website, you can either search by postcode. For example, Bella Vista's postcode is 2153. We click on go, and these are all the asking prices for all houses, 3-bedroom houses, which is a typical number of bedrooms for houses, and units. The only difference here is that they are actually asking price instead of sales price. It could be a bit higher than the sales price, but trends are the same. And instead of postcodes, if you want to check data by region or city, just click on that button and it will show you all these capital cities. And also you can check the trends across all these regions. Yeah, so both the suburb profile from REA and this SQM research are totally free. So now we've covered the what, the why, and where to find our data. Now it's time to explain how we use the data. And now it's time for me to explain to you how we calculate the relative affordability in InvestorKit. So basically, we call it a overvalue or undervalue assessment. How do we do it? Firstly, we calculate the 30% of the local average household income. And with that 30% amount, we calculate how much of a loan you can get from the bank with that monthly repayment. So that 30% amount would be the affordable level of your monthly mortgage repayment. And with that monthly repayment, we can calculate the amount of money you can borrow from a bank. And if we assume that we borrow 80% from the bank for your property and we use 30 years as your loan term, we can calculate the price of the house that you can afford with that loan. And that price level would be the affordable house price for this certain region. And then we compare the actual level of median house price of this region with the calculated affordable level of house price. If the actual median house price is higher than the affordable level, we call it overvalued. If it's 30% higher than the affordable value, we would say this region is 30% overvalued compared to the affordable level. And if the median house price is 30% lower than the affordable house price, we would call it 30% undervalued compared to the affordable price. So if a region is overvalued, especially when it's really so much overvalued, it might limit its further price growth. And while a region is undervalued, the housing demand of that region would be encouraged and we would have more confidence in its future price growth. Now that we've understood how to calculate the relative affordability and how to look at it, it's time to bust the myth. Is it true that the more affordable a region is, the better growth there will be? The answer is no. I'll give you an example to explain it better. The example is Broken Hill. If you don't know about it, it is a small town in the outback of New South Wales. For now, even in 2024, the median house price there is still under 200,000. Compared to the affordable house price level, it is 211% undervalued. That is really, really cheap. You would think it's a real bargain, but somehow it might be risky. Why? Because this town is a mining town as well. And when it is a mining town, you might want to be careful about the economic health and the housing market's long-term growth. Although in the past year, the median house price grew really well, probably because of the affordability. However, in the past 10 years, if you look at the long-term growth, the performance wasn't that impressive. So on average, regional New South Wales's house prices grew by 92% in the 10 years from 2014 to 2024. But in comparison, Broken Hill only grew by 50% something. That is the difference caused by the overall health of the economy. So in conclusion, affordability is not everything. You really want to check economy, housing demand and supply, and every influencer of the housing market. To summarize this episode, we started from what? We looked at individual affordability, the relative housing affordability, and the rental affordability. And why it's important: when a region is affordable, it's more likely to grow healthily, especially when we're in this high interest rate environment. And where do we find data to determine the affordability level? I showed you the data sources, where to find the income level, which is from ABS, and where to find the price level, which is REA suburb profile pages or the SQM research website. And then we moved on how to calculate the relative affordability level with the data or downloaded from those data sources. And then we busted a myth if affordability is everything. I hope you enjoyed the 4 pillars of profit-driven data. Pillar number 1, population and demographics. Pillar number 2, construction activities. Pillar number 3, economic strength. And the 4th and final pillar, affordability. When these 4 pillars are used correctly, they produce a foundation that can create huge profit from property investing. If you want to learn any more about property investing, get in touch with the InvestorKit team. Click the link in the show notes below and you can chat with someone from InvestorKit today. I'm Junge Ma, lead research analyst at InvestorKit. Thanks for watching. Happy investing.